The shutdown's over, but is the market still flying blind? The longest US government shutdown in history has finally ended, and markets are looking ahead to what's next. Rate cut hopes are back in focus, but with key economic releases unlikely to be released, investors will have to rely on private data to bridge the gap. So, what are they telling us? Tim Graf is Managing Director and Head of Macro Strategy for EMEA at State Street Markets. So, Tim, let's start with the labour market. ADP data showed companies cutting more than 11,000 jobs per week. Is the employment engine really sputtering?
Yeah, I think it is. When you look at alternative data measures like things like job postings or wage growth that companies like Indeed produce, what you see is this just continued leveling off of the labor market. It's probably not quite as bad as some of the ADP data would indicate, but considering some of the constraints on labor supply, the break-even rate for monthly payroll growth is probably somewhere in the neighborhood of 25 to 50,000 jobs. So the modest contraction we've seen from ADP data is not a million miles from that. And indeed, postings and wage growth, as I mentioned before, are also commensurate with a labor market that really is kind of at a standstill right now.
Well, President Trump says inflation is at a perfect number, around 2%. Are price pressures really in the rear view mirror or just political spin?
For the largest part, I think they probably are. You have seen upside pressures to inflation via tariffs, and we've tracked this actually with our own alternative data measures through the State Street Price Stats Index for the U.S. And it does show that U.S. inflation is stronger than normal. Prices have risen probably 50, 60 basis points more than normal this year. But that's actually not as bad as what was forecast. And then, of course, if tariff pass-through effects are soon to cease, that will start falling out of inflation calculations next year, which I wouldn't consider it a perfect number right now because there is still the risk of upside inflationary pressure. But I think the stars are aligning for better outcomes starting in the new year.
Meanwhile, let's look at the growth picture, and the CBO says a 6-week shutdown could shave 1.5 percentage points off growth this quarter. Is that damage temporary, or does it leave a deeper scar?
There's probably some temporary scarring, and I think the effect itself will be temporary. This is a temporal effect from the shutdown. Shutdown is now over. Workers are going to get back to work. Production's going to come back online in terms of what the government does for its citizens. So I think it's largely a temporary effect. I think the estimate they have is probably a little bit overstated. That's not typically as big of a shock as you tend to see during government shutdowns, even if this was the longest. But nevertheless, I think its effects will fade in time.
Markets are now split, about a 50% chance of a December cut from the Fed. How do you see the coin flip landing, and how deep could the easing cycle run into next year?
Yeah, it's a good question. By then, we should have some more official data, hopefully. And we'll certainly have more reads on the alternative data. I think just given what I've said about inflation in the labor market, the Fed is probably more likely to ease than not. In his last press conference, Jay Powell actually mentioned looking at the price stats data that I just talked about. And that coupled with some of the alternative data on labor markets would suggest that further easing is probably required. And I think we certainly get rates to 3% by the end of next year. I think my core scenario, though, is that we get there by mid next year.
Finally, Tim, traders are bracing for a spike in dollar volatility as more data comes through. Meanwhile, RBC is warning of a prolonged sell-off. Should markets duck and cover?
Where the dollar is concerned, I think that's probably more of a 2026 trade. It's done very, very little net over the last 6 months or so. And I think with year end approaching and position risk is all still very aligned dollar negative. I wouldn't really look for that downtrend to reassert itself until maybe some of that positioning has been cleared out a little bit. And until you start to get some new catalysts for that dollar downtrend. And I think that comes in the form of further Fed easing, potential further slowing of the US economy. Those factors, I think, are ultimately going to weigh. I do agree with that long-term dollar down view, but I suspect you're going to need to be patient to see that play out.
That was Tim Graf from State Street Markets. Don't forget, you can watch more videos on Reuters.com.